Hi everyone, welcome to today's webinar, Know Your Numbers. My name is Caroline and I will be your moderator for today. For those of you who are unfamiliar with the webinar environment, these are the Zoom settings. You select audio settings to select and you test your speakers. If you have any questions, please submit them via the chat box. We will answer the questions in the end of the webinar if time permits. If you need to leave the meeting, just click leave at any time. When you do leave the webinar, there will be a short survey that pops up. We will really appreciate if you could take a minute to answer the questions. Now I would like to introduce today's presenter, Tom Beswick. Welcome, Tom.
Caroline. Great to have everyone joining us today. We've got people across a range of clients from all sorts of different types of businesses, shapes and sizes. Ingham has been helping the Bay-based clients for the last 60 years, and with all things going well, we'll be around for the next 60. Our brand promises are to help clients build financial well-being, provide advice when you need it, and help you focus on the big picture. One of the core values that we have is that we want to make an impact on clients' businesses. And one of the ways I know we can do this is helping with education. A lot of businesses we see are run with very little understanding of how the numbers really work. And with Xero and modern systems, we're well past the days of waiting for the accountant to tell us what's going on with our businesses. Hopefully this webinar will just help you along that journey so that you can progress and feel a little bit more confident about what your numbers mean. Now, before I get into the meat of the session, I thought I'd share a bit of a thought that the budget is not just a collection of numbers, but an expression of our values and our aspirations. Now, if some of you are wondering what even that budget means, which might be a little bit tongue-in-cheek, then you won't be alone. A lot of my businesses really, if I ask them about a budget, it might be, well, I just want to copy last year. And that is an idea that I'm keen to help adjust or nudge along into a bit more of a productive output in the future. Now, hopefully you have all updated budgets and forecasts for the 26th year. And now is the time to make sure you can understand, monitor, and importantly, measure what you've set on those budgets to help you make decisions along the way. So what are we going to cover today? Hopefully we'll come in well inside 60 minutes so that we've got time for some questions. So do note those down, even if it's literally just a circle around something that makes no sense with a great big question mark. Come back to it. If you have that question, you can bet your boots someone else does as well. So we're going to cover why you need to know your numbers. An overview of the different types of reports that really every business should be producing regularly, the difference between profit and cash, key drivers of your business's value, and a little bit of commentary on how to protect your assets and adopt best practice in all areas of these items. We'll touch on some potential next steps for you that we'd recommend in many cases. Please make notes. If it sounds like I'm talking a foreign language, write it down. We'll come back to it. There'll be a lot of the same questions I would expect. And if I lose you at any point, I'm sorry. This is being recorded, so you'll be able to come back and say, oh, that's what he meant. So why do we need to know our numbers? It is vital. If we do not know our numbers, we can't interpret the reports and know if we're on track to achieve the goals that we set in our business plan. Now, that's talking best practice, even using the words business plan and goals. Not every business really has that. Some of them, it's literally, well, I'm comfortable and I do want to repeat last year. And that's something I like to challenge when I'm meeting with clients as well, is, well, the assumption that if I keep doing the same things, will I keep getting the same return? And these days, I don't know if that's always going to be the case. With many changes in the business environment, with AI, with the economy, with moving interest rates, there's lots of reasons why doing the same things as we did each year will lead to less. So we need to know our numbers because they tell the story of the business. They help us to understand what's been going on. Helps us to identify what's a symptom and what's actually the root cause of that symptom. For example, a decline in gross profit is a symptom of many root causes. It could be something like ineffective pricing, or maybe you've got team members causing you rework, or maybe your purchasing habits are poor, or there's been inefficiencies along the way and wastage. We need to know what the problems are by good reporting, otherwise we can't ever hope to fix anything. So knowing your numbers helps you to spot an early warning sign of a potential issue. For example, if you're not monitoring how long it takes your customers to pay you, you might not be able to take action quickly enough to get cash in the door. Your number 4, good understanding of your numbers will help you identify areas of strength and weaknesses in your business. For example, understanding your balance sheet helps you to work out whether your business value might be going up or down. And it is very common that most of my businesses would struggle to really do a good job of explaining their balance sheet to me. Understanding your numbers also means you've got reliable financial information to base your decisions on, which is really key. There's a lot of very poor and sad-looking Xero files out there, and they are a little bit unreliable until they've been tidied up. That's not where we want to leave things. And finally, knowledge is power. It might not just be power, it might be confidence. I've had a lot of people in meetings who are uncertain, and they stresses them out to not know how their business is going from anything more than what is their cash in the bank. Many of them bring the same attitudes they had about their numbers that they had at fifth form maths level, and there's a lot of people who didn't do that well at fifth form maths. Turns out in many cases that fifth form maths doesn't relate to your business expertise really much at all. But I do want to assure all of those listening that the numbers that we work with day to day are often multiple times easier than the numbers that many of your businesses work with. If you're a plumber, you're dealing with much more complicated numbers than we ever do. But it's just a case of taking the time to learn how it all fits together so that you can run a better business. So we'll go through these reports, what they mean. Sometimes the terminology is a little bit different. We'll work through a bit of an example with a foods company that is just sort of a good generic example. Very little changes in these understanding of reports. So the example stands no matter how long ago it was. So the first report that many of you will be familiar with is a trading account. Now, you might see this as the first page of your profit and loss report if you've ever run that out of Xero, or you've sat with your accountant to talk them through it. So this trading account tracks your sales, your variable costs, your gross profit to calculate the return you're achieving before covering your overheads. So your variable costs, that's quite a good one to understand. Those are the costs that move based on how busy you are, basically. So if your sales have doubled and you've had to double the team in order to keep up with that sales work, those are variable costs because they change based on how busy you are, whereas your rent probably doesn't. So that's more of an overhead. So your gross profit is telling you whether your margins are improving or deteriorating. And for most businesses, that gross profit percentage is an absolutely important KPI, key performance indicator, to track and to measure and be conscious of movements. Now, another thing which some successful businesses do is when they have different divisions or product lines or maybe regions, actually tracking their trading account across those different areas. For example, if you've got regional locations, you want to have a different trading account for each location. It might be multiple stores, it might be multiple branches. You want to be able to track those because otherwise you don't know which one is going well and which one isn't. Many people's financial systems are set up to ultimately cause a tax return to fall out, and that's not really the right priority. If you've got one sales line and umpteen different overhead lines, actually it might be the wrong way around. That might not be the best way of understanding how your business is performing, and tax is really a small part of all of that. So getting your accounts and your structure set up in the right way so that you can understand how your business is going is absolutely critical. So at this trading account level, small adjustments can have a huge impact on results, and we'll go through an example of what that can mean. So here we've got our fictitious company. and we've got annual results, and say we're starting with sales of just over $1 million. And then we've got our cost of sales, which is just our movements and inventory at this point, of 318,000, which means before we've paid the staff and other delivery costs, etc., we've got gross surplus of 700. We then pay this team, which is costing 450, which means we've got 250,000 of gross profit. Gross surplus, same word. You just become gross profit, or otherwise gross profit percentage. So that 24% is telling us that out of every dollar of sales, we're making 24 cents in order to cover our overheads and to cover paying owners, paying for profit. So we sometimes people will look to us and they'll say, well, how can I make that better? Because when we come to the next page, you'll see that it's not really covering their bills. And so that's why it's critical to report this, because sometimes it's a case of, rather than just saying, okay, well, we want to do everything better. Well, what does that mean? Let's break it down. Let's put a tangible goal on one thing and do one thing better and see how it goes. So let's say we were working with this company and they identified that they wanted to improve sales by 10%. And they wanted to work on lowering their cost of sales by 5% by tidying up some of the inventory processes. And they're going to negotiate some of their contract with their delivery provider. So we're seeing we've got some strategies that we want to put in place to bump sales by 10 and lower some of our costs. Well, understanding this report is really key, because if we're able to do those, the big question, well, how much of a difference to our gross profit is that going to do? And it's significant. So if you see here, we now have bumped sales by 10%. We've got cost of sales coming down, and critically, a whole new level of gross surplus. So those changes, which of 10%, 5%, might not seem that significant in themselves, actually 50% extra to gross profit, which makes a massive difference and will make a massive difference to any business. Now, it doesn't mean that there's just a simple thing to do. But once you've got your numbers in a state that you can rely on, that you're looking at regularly, then you can say, okay, I can't increase sales by 10% overnight, but what am I going to do to work towards a 1% or a 2%? And then in 3 months' time, where am I going to find another 2%? And then if you've got that confidence in your numbers, there's a lot of power in that towards improving businesses. So understanding the trading account is really critical to allow you to identify areas where small improvements, as you can see, have a big impact on the business. So then we come into a profit and loss statement. That might be one and the same as your trading accounts, but that's also called an income statement in some places. That shows all the earnings and costs over the year, tracks your performance for the business. It matches your income and expenses for the period, or it should do. For example, sales that have been made out of money, but the money hasn't been paid for yet. So things like debtors will come into your profit and loss as you've earned the money, you just haven't received the cash. What can muck up your profit and loss, and we see this in lots of businesses, is things like work in progress. So that's where you've done a lot of work, you've spent a lot of money paying staff and buying gear, buying equipment, materials, but you haven't got to the stage where you can bill someone for it yet. So what that's going to do, and let's say that all happened in March, that's going to bring a lot of costs into the March year, but then the sales might happen in April. So you don't then have a timing match, and that's where it's important to look at your profit and loss and make adjustments for timing, because you could then have a profit and loss that's wildly swinging month to month, and that's really hard to make decisions with if that's the case. Now, it is important to remember profit is not cash. The profit shown in your profit and loss does include things that are non-cash, like depreciation as assets go down in value. You've got to have enough profit to cover things like paying your loans and paying yourself. There's a lot of conversations that I've had over the years where I'll show someone some reports and the profit and loss statement will look good, and then they'll say, well, where's the money? And that is sometimes a case of just not understanding the differences differences between profit and cash, and we'll cover that later on. It's pretty easy to learn and get your head around, but very commonly mistaken. So this P&L statement provides a framework to benchmark your results using percentages or comparisons between years. You might even be able to compare yourself to other businesses with these reports. It's important because businesses are generally valued using a multiplier of earnings, so a number of times your profit. In many cases is a way that businesses are valued. So if you're able to get $1 of extra profit, that might add $3 of tax-free gain when it comes to sell the business. So if we're going to break down a profit and loss statement here using the same company, see at the start of the top of the screen, we've got that same profit that we had before. And it comes down at the bottom of the page to a big loss of 113,000. So this is not a sustainable situation. We do need to make some significant changes in this business, otherwise we are going under. So let's say we've taken a review of expenses with the client and we've helped them identify some savings, perhaps in insurance. Perhaps we've had to have a frank conversation with the landlord and say, look, we're either going to be falling over if you can't give us some relief here. You might have an empty building. So sometimes there is a straight up conversation that's had. And so then we're working out, okay, well, if they save these minor things, which are minor, but they all add up, how much of a difference might that make? So then we've saved $600 on insurance and maybe a bit on rent as well. Now, you'll notice that, yeah, their costs have gone up. They've had to pay accountants, pay business coach, perhaps, for some advice. Now, then that's a critical thing, is obviously nothing is free. However, if they see it as a cost, well, they should minimize costs. Of course, if they see it as an investment, then it's a case of how do I get the most out of that investment and make sure that as a multiple of that investment, I'm making money. I've had to pay $5,000. Well, am I at least getting 15 back for it? Asking those kinds of questions are really important, because then you understand, well, where is the value, where I'm spending money. So after all those unders and overs with these changes, you can see $138,000 of extra profit. So we've gone from a loss to a small profit even after the owner's paid. Having the confidence in these numbers really helps you to understand them a hell of a lot more and take specific actions rather than just simply doing things harder, doing things more. And I know many businesses that I see that's the default strategy. I'm just going to work harder. I'm just going to do more hours. And that's not always a viable situation. It doesn't always lead to the improvements you think, let alone it just runs energy levels can only go so far. So small, deliberate actions with good numbers behind them make a big difference. All right. So then we come on to the balance sheet. And when I'm sitting there at the end of the year, maybe reviewing some annual accounts with a client, most of my clients will understand the profit and loss results. By the time we get to the balance sheet, I'm starting to lose a few people. So that's totally fine if I lose a couple of you. Hopefully you'll pick up a bit of understanding from some of this today. So what the balance sheet does, sometimes also called the statement of financial position, it provides you a snapshot of your business's position at a specific point in time. So the year end for most of you will be 31 March. So it's as at 31 March, this is what you had as assets, like your cash, the people who owed you money, all of the things that were in your control to turn into money. And it also then shows what you owe. It can show you, or will show you, if your business is solvent, which means is your liabilities greater than your assets? If it is, you've got a bit of a problem, because that's not a business that should really be trading, and something you really need to talk to your accountant about if your liabilities were greater than your assets, because what can happen then is the risk that a business is trading insolvently, which can lead to personal liability of a director. So that can pierce the corporate veil, which means look through, even though you've got a limited company, sometimes they'll still cause you to for your personal assets to be at risk. So the balance sheet will compare different periods, determining whether the business's net worth and net assets are increasing, which is a real key metric for the strength of the business. The stronger your balance sheet, the more net assets you have, which is assets minus liabilities, the easier it'll be for your business to survive in a downturn. or anything negative that happens. So if we look at a sample balance sheet, we can see this company is actually insolvent because we have current assets of 138,000, but they are less than our current liabilities. So meaning we've got more bills to pay than we can pay. We can't pay our short-term debts. We need action to fix this. So this might be funding from a bank. It might be funding from an investment that a shareholder has to liquidate. But it's not a sustainable position, as you can imagine. And what we've got is 305,000 of more liabilities than assets. So we need a significant injection in this case, or a significant turnaround plan at the very least. So looking at this balance sheet, that's where we can also look and say, well, are there things that we can do to this balance sheet to help our situation out? You can see our cash balance, is sitting in the negatives and the overdraft. We don't want that to continue. We might be running out of overdraft. So one of the things we look at, and we can look at, is, well, what's your debtor days? And that's simply a function to say, well, on average, how many days does it take someone to pay you? In this case, with this formula, it's telling us that on average, people take 26 days. So we can look at that and say, well, okay, if you were to look at your terms of trade and say maybe you might switch to 7 days, then that might be something that you can do to lower your debtor days. And if they did that, and obviously it's not going to mean everyone pays in 7 days, but in this case, let's say it took 5 days off their debtor days. Well, we can work out, well, how much cash is that in the door? So that's 14,000. Well, that 14,000 helps, adds to the mix to help us keep the doors open. Another thing we might look at is inventory days, and that's the number of days that you've paid for inventory and it's sitting around and it's not sold. So in this case, it's 74. So we've got stock that we're paid for on average sitting around for more than 2 months before it moves out, which is getting up there in many businesses. So what kind of strategy? Maybe, maybe we need to put some inventory processes in place to lower the amount that we have to hold on to, which means not having to pay for it as early. So in this case, we've got a formula to say, well, okay, well, let's say that we put some processes in place and we save them 9 days. Well, those 9 days means $8,000 in the bank. So it's pretty material. Even though it might not seem like that much, we've now got $22,000 in the bank that we didn't have before. Having good numbers means you can work with this. If you can't trust your numbers, very hard to put steps in place. All right. So now I'll definitely have lost everyone by the time we got to the statement of changes in equity. And to be fair, most of the time you'll only see this as in your annual financial statements. And it's actually not as hard as it sounds like. Basically, what the statement of changes in equity is showing is what's happened to profits. So if there's been company profits left in the company, have they been left there or have they been allocated out as dividends to shareholders? So that statement shows the changes in net worth or the value of the company, and it is an indicator of financial health and helps tell us if the company is solvent. Can it pay its bills? So in this case, it's quite a simple statement. It's showing us the movements year on year, and it's showing, well, we've been losing money these last 2 years. We don't have money to pay dividends, and we actually need to get money in to keep this business going. We need to take action. So normally all you'll see is the profit and loss for the period coming either in or out of equity, and if there's been any dividends paid out to shareholders or allocated. And the dividend is simply company profits now allocated as shareholder income. Okay, so this one is quite important, and most people won't understand it, but it is useful to start to get your head around. So your shareholders' current account, again, it shows up probably mostly only in your accounts. But what it does is it records all the money that's been put in by shareholders over the years or taken out as drawings. So it can help you monitor your personal spending from the business. And for a business with more than one shareholder, it also keeps track of the amount that each shareholder has put in or taken out of the business. So if you were 50-50 with an unrelated shareholder, you'd want the business to also owe each of you the same amount. And quite commonly, we need to do a wash up each year to bring that into account, because one shareholder, for some reason, has taken out more than the other one. Now, understanding the movements that are in your current account are really important, because if we've treated something as personal when actually it related to the business and it should have been a business expense, well, that can make a difference to the tax outcome quite significantly. So if you're in a situation where the company is owed money by you, then the shareholder actually has to pay the company back in some shape. And if it doesn't, then we might have to charge interest. The company has to charge you interest. It's a bit of a negative circle. So if we go and look at this next example, the shareholder's current account starts with Mr. Doe as a shareholder being owed 30,000. And then he's put a little bit of money in over the year, 2,000, but he's also taken some money out, even though there hasn't been a great profit situation. It's actually been a big loss. So quite often there still is some kind of spending. And so that's gone down by nearly 10,000. So we finished the year where the company owes Mr. Doe $22,000. Now that's actually the right way around. That's the way that he wants it to be. We don't want the situation where he owes the company. Because what can happen is, obviously his company is not in a great trading spot with more debt than he can pay with his assets. If he owed that money to the company, if it was 22,000 that he owes, then if his company did tip into liquidation, the liquidators would ask him for that money, and he would need to cough that up somehow. So if you don't understand that, that's fine, but do try and learn it. Ask your accountants. Don't just say, yep, I get it, when you don't, when we catch up with you. It's perfectly fine to not get it, but literally it's all the movements, the cash that might have left the business or gone into the business that wasn't something we could claim for tax. Maybe it was money that you've advanced. Sometimes there'll be movements through here because you've taken a loan personally and put that in the business. That would increase what the company owes you. All right. So then this one, the fixed asset register, is a report. You probably see it at the end of the year. It records your fixed assets, vehicles, plant, bits and pieces that you picked up over the business's life, usually over $1,000, because below that we can claim it straight for tax. It's providing a basis for keeping track of the business's assets. So it can be a useful guide to determine when assets need to be replaced, so you can budget. And that's quite important, as sometimes the ID has said this asset usually lasts 5 years. So then we'll adjust the depreciation to claim that over 5 years. It'll be 20% claimed every year. Well, does that mean that you then need in 5 years' time to buy a new one? Well, not always, but sometimes it does. And so understanding how much cash I'm going to need to keep my assets up to date, keep my business going, is actually quite important, and does affect the business value. If the assets are run down and there's no book value left, it can be a case that the assets are actually dated and a new owner is going to have to spend something bringing it back up to spec. So there's a lot of numbers in this slide, but basically all it's doing is showing the movement in the value as the year passes and as depreciation is claimed or as new assets are purchased. So the first column just shows your names and the original cost. Then we've got the opening value. So that the difference being there, that there's been depreciation calculated in the past, say on this first van. And so at the start of this tax year, we've only got nearly $8,000 left that we can start claiming. Then we're saying, okay, have we got any movements? Well, okay, we spent some money on building a website this year, so that's added onto our fixed assets. We haven't really sold anything, so there's no movements to speak of there. And then we've got the depreciation rate. So that's simply how many years does the IRD let us get rid of this asset over. Sometimes that can be faster than they actually do go down in value. So that's something to watch. Sometimes your cars will have no value on the books, but practically you know that you could sell them for more. So that's something to be aware of. Sometimes that could cause depreciation to have to be paid back if you sold it for more. And then the closing keeps closing accumulated depreciation is what that column means. That's literally tracking how much have we claimed over the year and over the prior years altogether. So that's adding in this year's 2,000 plus all of the depreciation in the past. And then a final column of what is our book value. So that does not mean this is what the assets are worth. It just means this is what IRD thinks this is worth. This is what we can have claimed and is our tax book value. And it can be useful to understand this as part of a business sale because sometimes that can influence the way you might put a sale and purchase agreement together. So that is a very whistle-stop tour of the first sort of 6 key financial reports you might see in your annual accounts. Each report does tell a different story, aids your decision-making in a different way. The ones we really want to focus on are your profit and loss statements, your trading statements, and your balance sheet. Do pass through any questions, but we'll carry on in the meantime to understanding the difference between profit and cash. So it is common to be frustrated that your bank doesn't match the profits that it's telling you, but there's some pretty key reasons why that is. Many of you will have seen cases where there's been businesses that are profitable, but they've gone out of business, and that can simply, you can actually grow yourself into failing, where you just don't have the cash to keep running. It doesn't mean that is not a good business. It's just the funding hasn't been adequate. And at the same time, you can have a business that's running at a loss, but it survives because it's got great funding sources and it can fight another day. So cash flow is reality. So you break it down into some common movements between profit and cash. So if we look at GST, do we think this affects profit and cash, or is it one or the other? So when we're doing a profit and loss report, GST is always taken off it. So it doesn't come into your profit, but you have to pay it. If you're making money, you will pay GST. So it affects your cash. If we pay the loans, well, we don't get to deduct principal off our profit, so it just directly hurts our cash balance. But the interest on loans comes off profit. We can deduct what we borrow, our borrowing costs. And because we've paid that interest, it also comes off our cash balance. So that's a key difference compared to the principal repayments, which are kind of like forced savings in a way. If we buy gear, so this is a classic one that we do see. So it doesn't hit our profit straight away, not until we get to depreciate, but it does hurt our cash. And we see this very commonly where someone goes out and buys a new digger, for example, and they've got money right now because the time of the year means they've got cash. Well, then have they thought about next month's GST to pay? Have they thought about provisional tax? And not always is the answer. And sometimes that then means there is a bit of a scramble to have to pay those balances because the cash they thought they had was actually really should have been earmarked. So as you can see, even if your business has a healthy profit, there might be not cash in the bank based on the timing and because you've got things to cover like paying loans and buying gear. And there's one other with asset sales. Well, that's just going to hit straight into cash and depreciation. As assets go down in value, that will help your profit. Doesn't hurt your cash because you paid those assets off or you paid for them a while ago. So that's a non-cash adjustment. All right. So what is the Business 101 cycle? So this is kind of like a demonstration of how cash and profit work together. So you start off and start a new business. So you've got to put money in at the start, and that money will then get used to buy assets to fund the business. Sometimes it's not just your money. So you've gone to the bank and you've borrowed money. And so you've received money to buy those assets from outside. And then those assets need to be put to work to earn income, which we can make adjustments in order to grow that profit. So, for example, work on our sales strategies, work on how we grow our margin. But there can be drains of that profit. For example, if you've got mistakes, if your overheads are growing at a rate that they shouldn't, then our profit turns into cash. But we might have drains on cash. So it might be profit, but it's not coming into cash straight away. For example, if our debtors are slow to pay, or we're spending too much on inventory too early, maybe we've got high loans to keep up with and our loan repayment plan is too aggressive. It can all be draining cash really quickly. Maybe we've got tax arrears to deal with from prior periods, really hurting cash. But then the same token, there are strategies to be put in place to help that. Okay, how do we work on getting faster collection from debtors? How do we get a better tax strategy to pay less tax overall? And then most critical of all is we want to have cash to pay ourselves. We want cash out for our own use and paying our own loans, which we might have taken in order to buy into the business to start with. The remaining cash can be reinvested in the business to buy more assets and help spin the circle faster. So if you want to make more money, then it's about taking those assets, taking that cash and redeploying it and increasing the speed that that cash is reinvested and put to work and comes back out to you. All right. So just a little bit on what are the key drivers of business value. So after cash flow, business value is a pretty important measure of how success is tracking in your business. Part of knowing your numbers is understanding and measuring the drivers of your business value. So there wouldn't be many of my clients who would actually have a bit of a read on what their business is worth. And yet, ideally, the changes that they're putting in place are with a mind to, well, one day I'm going to sell. So is it going to help me or hurt me in the long term? So understanding what these drivers are is really critical. So sometimes they might also be called key performance indicators. So these are things that you want to track and you want to report on regularly, ideally monthly, if not more. So there could be things like monthly recurring revenue, revenue growth, revenue per client. There could be sales and profit metrics, not just the raw numbers necessarily, but sales per client, number of repeat transactions per client. They're very much business specific. And if you're not sure where to get started on identifying some of those key drivers, then that's something we can absolutely help with. Monthly reporting. So I know how attractive that sounds. It sounds like a real snooze fest. But out of everything that I've said today, that could be one of the most powerful things that you can implement in your business. Each month, I would recommend preparing a management report pack that includes a profit and loss, a balance sheet, your debtors and creditors report, a key performance indicator summary of sort of the 3 or 4 key things that drive your business, and a short-term cash flow forecast. Dedicate some time each month with a recurring reminder to make sure you do it and do it next month as well. To actually take the time to both run it and look at it and ask yourself, do I know what this means? And okay, now that I know what it means, what am I going to do about it? You want to be looking at things like for your profit and loss, you want it to include the current month versus budget and maybe the year to date versus budget. And then you look at that and you say, okay, well, I'm down. Okay, what specific actions am I going to take? Why am I down? Not, okay, I'm just going to push harder next month. So your balance sheet might compare your figures at the end of the most recent month to last month and maybe the end of the last financial year, so you can see how your assets are moving around. Debtors reports, creditors reports, you want to be looking at those for any trends or problem clients at least monthly, but just in a way that's a little bit different to when you just log into Xero and just see sort of the biggest problems, because sometimes you can miss the detail. And a KPI summary page is a great way of looking at how your business is performing. There are things like gross profit percentage or sales per customer, average transaction value. There are key metrics in every business where if you know that if I just manage that metric, then the business will be okay. For example, in our business, we track the utilization of staff. So how much time are they able to put on a client's code versus how much time are they putting on non-productive time? And if they're putting a reasonable amount of time with because they're doing work and they have work to do, then we know that the business will be all right. Conversely, if they're quiet and there isn't client work to do, then we know that it's going to be harder down the track because the cash won't be there. So understanding your own KPIs are really critical, and would really encourage some thought on that front. It doesn't have to, it's not a big job, but getting clarity can make a real difference. And then a short-term cash flow forecast. It should be in every management pack. And what we're talking there is not a 12-month monthly thing that we might do to get some money out of the bank, because that's really there's a lot of sins hidden if we just have a monthly report. We can't really see the unders and overs. So what I'd recommend for really every business, unless you're sitting on $1 million of cash, is a simple forecast that say the next 10 weeks of what you think is going to happen to your cash. Show your wages coming out roughly, show your GST bill that it usually is, and then you can forecast and not be surprised, because cash in the bank today is not a good guide. There could be 50 grand in the bank, but then GST next month is 30, and then you've got a monthly loan payment of 40. So you're actually going backwards, but you can't see that until you map it out. I haven't yet met any clients I can think of who can do this in their head. I sure can't for our business. So a simple forecast is absolutely best practice. Good man, and helps everyone to sleep at night, because they can see, okay, well, if this goes to plan, we will be fine for cash. There's good management reporting systems out there. There's great software options. There's no reason that any of this should take more than half an hour to put together. Maybe the cash flow forecast is a little bit more time, because you want to just each week that goes past, you just drop another week on at the other end. But after a while, it does start to kind of update itself, because you get a feeling of how movements are within your business and what your average bills are, etc. So if you want help with setting up a simple system and monthly reporting, absolutely, that is something straightforward we can help you with. So if you're thinking about, well, how do I make my business work more, then a clear plan is absolutely the starting point. If you don't plan, you fail to plan to fail. So every good business should have a plan. This does not mean it needs to be a 20-page document, but it should be clear, outlining what the key parts of your business are, what your risks are, what your goals are. Having good systems, real-time reporting helps you make better decisions. It helps you ask questions, and it's absolutely, asking questions is just as important as knowing the answers, because you're helping yourself realize now that I don't actually know what these numbers mean. Well, we may as well learn that now. You might have 10 more years to run in that business. Would you rather solve that problem and understand it, or sit there and be unsure and nervous for the next 10 years? Part of that as well, if you want to grow your business value, it's absolutely critical to work towards answering the question of, how do I make myself redundant? That's a really challenging thing, and absolutely cannot be solved overnight. But a business who's managed to take the owner mostly out of it is umpteen times more valuable than an owner who's in there doing everything. And if you want to grow your business value, understanding and managing your risks, that's something that will be part of a business plan, is risk identification, mitigation. Okay, I've got this problem, I've got this competitor, I can't do everything about it, but I can do this. Okay, this in the next 3 months, I'm going to do X to help resolve that, help mitigate it. So this is very quick through quite an important topic, protecting your assets. But we've seen through this brief presentation that profitability, cash flow, value of your businesses, it all affects you personally. If your business isn't profitable, it doesn't have the cash available, you're not going to be able to pay yourself and fund your own lifestyle that you want and that you're working towards. So there's a few other things you can do to help protect your assets, other than things to do with profit. And many of you will understand this in terms of you're trading out of a company. So that's the first thing that most businesses will do. But understand your responsibilities as a director and understand when that trading could be looked through. That's probably something a lot of people wouldn't have a good handle on. And so this limitation is not absolute. Directorships. Consider who should be a director of each of your companies or your company, and what assets the directors then hold. So there's almost only downside in being a company director. So when it's him and her, and stereotypically she is not involved in the business, I'd say she shouldn't be a director. Let him go to jail if he's not meeting his health and safety requirements. Understand what security you've provided. That's something where banks are very quick to get security over everything, and then they're not very quick to remind you that actually they could let go of some of that by now because it's been a few years. There might be things you need to think about, and as the business grows, where you could look at your structure and you might be worth moving some assets into a different entity. For example, if you owned your own building, you wouldn't want that in the same building as your trading company. That could be at risk if something was to go wrong. Really make sure you understand your terms of trade and credit policies. These are not set and forget and never come back to them kind of things. Make sure you provide credit to customers who are likely to pay you. There are some times when we see people who they think that's amazing, they've got a new client. Well, in times like now, where in some industries it's actually quite tough, ask yourself, well, why are they coming to me now? Has everyone else said no? And then, okay, well, am I doing my credit checks? Because finding out ahead of time that someone's got a credit problem is way better than thinking that you're going to keep the team busy by supplying them, because all you're going to do is just push a problem out and not get paid. Understand your insurance. Has this been updated? Has your business interruption insurance, your indemnity insurance been changed since you started the business? Some cases they don't get thought about, and we never want to see someone who has a problem and they realize they're undercovered. There could be some financial planning, and this could be thinking about wealth outside the business. How are we setting this up for minimizing tax, for estate planning, for helping ensure consistency of your assets and protection? Do you have this not very attractive kind of questions that come up sometimes about your plan for the future and your estate? Things like wills get out of date really quickly. Have you done powers of attorney? These are all pretty critical. If some of those things are not in place, it doesn't matter how good your business is, you can still come a cropper. And family trusts are absolutely their own topic. If you have one, make sure you understand what it is. And that it is working well for you. If you do not have one, it is absolutely still a path that some people will tread. We do not make them the way that you used to, but they absolutely do form a valid way of protecting assets. And there's some industries where I would strongly always still recommend the use of them. But they just require more work than they used to in order to make sure they protect things as well as you want them to. So, in terms of summarizing all of that, what we see our most effective and successful clients doing is ongoing reporting and accountability. So the reporting aspect is so that they understand the numbers they want to achieve, and they are able to compare against their budgets and against their plans and know whether they met them or not. And then the accountability side is that our best clients do engage in some kind of coaching, or whatever word you want to use. Accountability, I prefer, using someone to hold them accountable. We do this in our own business, and we set goals and we say, look, we want to do 3 things. We don't want to do 100 things. If we set 100 things, we'll never do it. You'll never get action. But 3 things that we want to do by the next 90 days. And then if we don't do them, there's a cost. It's a pride cost more than anything. But there's someone outside who will poke us in the side and say, hey, what's going on? How can we do better next time? Okay, you did 2. That's great. Well, you got 1 left. Once you're accountable to someone, it's just the same as having a gym buddy. You're far more likely to achieve things. So we would strongly recommend thinking about how you get accountability, and that doesn't mean every day, but it's a check-in to maintain a healthier business. And then successful businesses will always have a business plan, and they'll always understand what their goals are with a forecast. Understanding your numbers is a beginning point, but it is not the end, because then it's a case of, okay, now I know what this means and I'm starting to learn more about it, but now what do I do with it, and how do I make those numbers work harder for me? These are absolutely important questions. So next steps, if you have anything that has come to mind or questions that you are thinking about, that you write them down. If you remember things, you write down far more than if you just listen and then move on to your next busy task in your day. If you're struggling with something, it's an opportunity to work towards it. There are many businesses many business problems. They are not a straightforward solution to everything, but just thinking, I'm just going to work harder. I'm just going to push towards it. Oh, I've been working on it for 2 years. Well, what have you done? How have you solved it? Well, there's still the same problem. I just haven't been able to move forward with it. The aim is to help take what you've learned today, hopefully, and implement some positive changes in your business. Some of that you'll be able to absolutely do yourself. Some of it you might need a hand. If you've got any questions about actions or anything that we've covered, then do write them down and come back to us. So think about what problems are you experiencing and what challenges have you had in understanding your financial situation, understanding your numbers, that you think, okay, well, I want to get on top of this. I don't want to be still in 5 years as uncertain about what all of this means as I am right now. Ideally, doing nothing is not an option. My dream, and I need to get my skates on in my career to achieve that, is so that every client of mine, I could give them their financial statements when we catch up and their results for the period, and they talk me through it, not me doing the talking. And they can say, hey, well, this part's moved up, which means this. That is a dream that I have, because I think then they've got agency, they've got control and knowledge, and they are able to feel way better and able to take real good actions in their business from a position of knowledge and strength rather than a position of uncertainty. So doing nothing is not an option. Ways we do work with a lot of clients. So as I talked about, we do a lot of work on the training space, coaching, providing accountability. It doesn't need to be a huge project, but little check-ins on a regular basis are really important. We do help a lot of clients put business plans together, and set their goals. And that, again, is not needing to be a huge, bigger than Ben-Hur project. It's a case of developing some understanding of your business and then putting some goals in place. And then, okay, now we've got goals, how do we turn those into simple actions? We work with a lot of people on their budgets and their cash flow. The key part of that is many of the ones we do are because someone's going to the bank and they want funds out of the bank. And then once they've got the money, then they never look at it again. I would say there's a lot of value as well in having a regular budget that you report against, that you create your own accountability against, and so that you know, okay, this is behind. We need to take action to get it back up. And we do an awful lot of work getting good data out of Xero. So Xero is a great software. There's a lot of power behind it, but rubbish in, rubbish out is absolutely true. And you can't just run a balance sheet, for example, yourself and expect it to give you good data if no one's ever tidied it up. So working with us, it's straightforward and helps you get your data in good shape. We are super confident that any work you did with us in this space would be absolutely an investment rather than a fee. That's not a sales pitch. It's just we know that businesses who do plan, who put time into education, just absolutely outstrip the ones that are just trying to keep up every day and never have time to work on themselves. It's not close. Absolutely, the best businesses are able to take the time to learn and progress with these kinds of topics. Everything that I've talked about today is absolutely general and not specific. So if you have specific things that you want help with, then absolutely just reach out, because one fix for one person is not the same for everyone. So I might take the time to move on to questions. How are we doing for any questions that might have come through, Caroline?
We don't have any questions that come through.
Well, that means I expect everyone to be experts next time I see you. That's all right. Like, there's a bunch of areas that we've jumped around on today. One that if something comes up, reach out. You've got my contact details when they'll get emailed through. with this the recording. If you come back to anything, if there was one thing that came out of it, hopefully you found that just that valuable. This is absolutely a journey for a lot of people, and hopefully that this has helped you progress on that journey rather than be at a destination where you think you've nailed everything. If you have, then well done. So we appreciate your time is valuable. Thanks for coming along. If you can please complete the brief exit survey, we'd find that helpful. Just helps us know what's useful, what wasn't, what was well presented, what wasn't, because we're always wanting to learn, work on particularly what you want to know, and because we've got a lot buried in our heads, but we want to figure out how to help everyone run a better business. And have peace of mind that comes from that, as well as financial success. So hopefully we've given you plenty of ideas to ponder and some clear next steps for you and your business.
Thank you so much, Tom. That brings us to the end of the webinar. Like Tom just mentioned, everyone will receive an email next week with a link to the webinar as well. If you come up with any questions later on, please don't hesitate to get contacted. Thank you so much for joining us today. Bye.